Hey everyone, I appreciate you tuning in. Today we have Ben McMillan, the Chief Investment Officer uh, from IDX. Ben is a principal and founder, as well as the Chief Investment Officer and Chief Technology Officer over there at IDX. Ben holds a master's in science of econometrics from the London School of Business and Economics, as well as his MA and BA in economics from Boston University. Previously, Ben has done things in his career such as being a portfolio manager at RQSI, where he developed and managed the RQSI Small Cap Hedge Equity Fund. His other prior experiences include things like being the portfolio manager and co-creator of the VanEck Long Short Equity Index Fund and developing and launching the Lister-Watson Long Short Equity Replication Strategy. In 2007, Ben was also involved as a co-founder of the cloud-based 13F analytics platform, Alpha Stratus, which later got acquired by eVestment. So Ben's a super interesting guy to talk to. We've been able to do some really good work with them in the past and rub shoulders with the guys over at IDX. They do some really cool things. And I'm really excited about the opportunity to have Ben on today, pick his brain a little bit and get his take on what's going on in the markets, the economy, and his thought. So Ben, starting out, one of the first things I do want to ask you is, man, what's your favorite investment quote?
There's a lot of good ones. I'll give you two. I'll give you, I think my top favorite is David Ricardo. He was an economist, a British economist from the late 1700s, and he was a professor. And he was the one that said, I believe the exact quote is, cut short your losses and let your profits run. So, he was kind of the original momentum guy. And he made it's worth noting, he made a literal fortune, following his own advice, as opposed to ironically, Isaac Newton, the father of calculus, lost a fortune, doing the inverse, kind of chasing the FOMO trade. So that's a good one. I think that's, that resonates a lot kind of, throughout history, but, most recently now. And then another good one I think is Warren Buffett. When the tide goes out, everybody knows him for saying, be greedy when others are fearful and fearful when others are greedy. But the one I like is, when the tide goes out, you see who's swimming naked. And again, I think in particular in recent years, that's applicable when you've had a lot of kind of, crypto's a perfect example, just as a poster child for, kind of fly-by-night operations masquerading as, things that are more legit. It's important to kind of, in this game, keep your wits about you always and, just really, kind of stick to core principles. So anyway, that's my number one and two.
Okay. Very well spoken for somebody that I would expect that manages risk and likes to be pretty grounded. What's your long-term view on the markets and the economy? As not today, not this year, but just your overall long-term view.
So what's interesting now, as it relates to, I think the U.S. in particular, is we've had this, kind of unprecedented bull run as a country. Forget about the markets. It's just, and again, Warren Buffett talks about this. He says there has been no better time. He refers to himself as being so lucky because he says there's been no better time to be an investment manager, in America, or just an American in America. If you go back, we've had kind of dollar hegemony, really since World War II. We've had growing demographics. Demographics explain a lot. There's a book out there called The Fourth Turning. I highly recommend people read it. If not, go find the guy talking about it on YouTube, because he talks about how important demographics are for, predicting long-term trends. And the baby boomers were a boom, this demographic boom, and with them came a huge growth engine. And now that's starting to wane, and we've had the Gen Z kind of be the echo boomers behind them. But demographics are starting to wane, not only in America but also globally. I think the only countries that have a birth rate above replacement right now are all African nations. Everywhere else in the world, population decline is becoming a real issue. And if you zoom in on America, we're at a point now where it's starting to, I think, become the early days of the world moving away from, a kind of dollar denominated global hegemon. You're starting to see, kind of the antagonistic countries right now, Russia and China start to denominate, big commodity deals outside of dollars. One of the best things, Nixon ever did was aside from Bretton Woods, was negotiating dollar denominated oil. And so, I think it's going to take a generation or two, for there's a lot that has to happen for the world to move away from the dollar. But for the first time ever, we're starting to see that. So again, that's not something that's going to impact us over the next, 1 or 2 years, or frankly, even 5 or 10. But looking out for, the next generation, I do think, I don't think it's the end of America. That's not where I'm going, but I do think there's going to be a shift in power away from the dollar, and that has implications, as it relates to our markets, longer term. Now that said, on the flip side of that, America is still the freest country. Certainly when it comes to markets and, the ability to start businesses. Anybody who's spent any time in Europe or has any kind of European friends I was shocked when I was living in Europe and I would talk to these Germans, for example, and, for them to start a small business, it's like a 6-month endeavor. And here in America, you can get it done in a week. You can have corporate docs. So, it's very difficult to see how any other country could come up with the next Amazon or the next Google or the next Facebook. America still leads there, despite, all the problems that we have. But I do think it's, America's going to remain the superpower, I think, for the foreseeable future. But we're starting to see the beginning of, potentially a different constellation of, world economy. And so I think that has interesting implications. And then, like I said, demographics in particular. So, that's not necessarily, bullish or bearish long term, but I think it does bring with it, a new set of opportunities. And I think it's going to look very different than what we've seen in the post-World War II era, where it's just kind of been upwards growth, forever for America. So, yes.
So for better or for worse, you feel change is on the horizon, and it's in a really significant way, but it's nothing imminent or immediate in our face, but it will come.
Yeah, well, and I think if you even zoom into where we are right now, I think 2022 was a perfect year. For people in our business, it was the first time really that most people saw, bonds go down, drop the way that they did. We were just, joking in a previous conversation about, I was talking to an RIA about, Bitcoin, and he said, Bitcoin's not the issue in 2022. He's like, Bitcoin's down 70%. I expected it to be down 70%. What I didn't expect to be down as big as it is my bonds. My core bond portfolio being down 40, 50%. That's what caught people by surprise. And again, you go back to, now let's zoom in and kind of, the last couple of generations, since the 70s and 80s, it's been declining interest rates. And it's just been, you can kind of throw a dart at bonds and make money. Bond risk was, really just opportunity cost. Now, all of a sudden, investors have been, very violently confronted with, the two primary risks of this fixed income, which is duration, which we saw, rear its ugly head in 2022, and then credit, which is, one thing I think to keep an eye on this year, because I think that's a tail risk is, some potential stress in the credit markets, a potential credit event.
Yeah. Do you think a lot of the risk realization that happened in portfolios was more of a result of people just managing to the credit risk and discounting completely the duration risk that bonds were carrying because of the environment we were in for so long? Or do you think it was more of potentially just like the inflows, the modern portfolio theory, that shift that we've seen to, passive investments, just kind of propping it up, and so it was getting auto allocated without a consideration for the whole picture of the risk?
Yeah, so that's an excellent question, and it raises an excellent point, and it's one that I think is very underappreciated, which is, so to answer your question directly, I think it's both, and I want to focus on the second one because that's the one that I think is underappreciated, which is this active to passive migration that we've seen really since 2008. And in the intro, you mentioned hedge fund replication. That idea after 2008, I was sitting at a fund of funds that was making, was running a fund of funds. So institutions would invest in us and we would allocate that capital to other hedge funds. And one of the guys that I was working for, one of the PMs, the guy who hired me, He was actually an old bond trader. And he was really sophisticated, really sharp guy. He was actually one of the guys from Liar's Poker. He was the guy, in fact, that said, if you want loyalty, get a Cocker Spaniel. The irony was that he was a really kind of quiet, soft-spoken Buddhist guy from upstate New York. And so I always teased him that, that line was immortalized by Gordon Gekko. But he was a sharp guy, and he never liked the idea of locking up money with hedge funds. He thought there was kind of an asymmetric operational risk there, which there certainly is. And, post 2008, there was kind of two things that happened. There was, hedge funds would gate liquidity, and then Madoff happened. And so that's where the hedge fund replication business came from. But the bigger, the bigger thing to come from that was the huge migration from active to passive. And anybody who was in the industry at that time will remember, everybody just kind of threw in the towel on active managers. I wrote a couple of papers about it. I mean, but CNBC, Bloomberg, they're just like, the hedge fund value prop is done. Active managers don't deliver value. Buffett famously got out there and made it bet with some fund of funds that 10 years my S&P allocation is going to beat your allocation. So Wall Street wholesale went into passive investments. You couple that with the rise of the next kind of for lack of a better term, echo boomers, which is kind of like a millennial plus Gen Z. And all of them are dumping into 401ks as boomers haven't left the workforce yet. So you've got this boom in 401ks, also benchmarking to passive investments. And that's where you start to see kind of, market cap weighted indices, exhibit a lot of power. Market cap weighted indices started, kind of expressing these internal momentum dynamics that were self-reinforcing. And so that's when index construction and therefore ETF construction really started to matter. And fixed income is a perfect example. If you look at the Barclays Ag, index, it actually only covers about 50% of the bond universe. It's very focused in treasuries, which is expected, IG corporates, investment grade bonds, and then agency mortgages. It pretty much entirely ignores like, muni bonds, high yield bonds, bank loans, which is a really interesting sector. And so, and it's also become, for lack of a better term, a victim of its own success. As it's become a forced buyer, because of all these rebalancing flows, it has to go out there and buy whatever the index is. And so one statistic that I like to, show people is if you look at the average duration. So let's forget about credit risk for a second. Let's just focus on the duration of, the Barclays Ag. It was on the order of, 10 years ago, it was on the order of maybe 4 or 5 years. Now it's almost double that. And again, that's because it's just a forced buyer. Russell 2000 is another perfect example on the equity side. Russell 2000 is a comprehensive index. And, Russell has since come out and said over the years, like, listen, we never, we didn't design this to be the best investment index. We designed it to be, the most kind of representative of small companies. Well, small companies are generally unprofitable. And so there's that kind of famous statistic that, at any given point in time, anywhere from 20 to 40% of the Russell 2000 companies are unprofitable. And if you look at a different index that filters for profitability, like the S&P 600, you see a lot of, superior risk return characteristics over time. And so my point in all this is the active to passive migration really catalyzed a new era of investing. And it was one where we saw a huge proliferation in ETFs, which has been good for investors on the one end because it's been a very democratizing force. Bank loans is a perfect example. Without an ETF, it'd be very difficult. None of us would be able to invest in bank loans. All of a sudden, we have that at our fingertips. But we also have to be more cognizant of, and we've seen it this year, the Magnificent Seven effect, where these top 7 stocks are driving, the entire market. And it's because it's market cap weighted index and they're getting all the passive flows. So anyway, I don't want to go off and do a 60-minute TED talk on this, but you raised a very important point, which I think we're at kind of a pivotal area now where investors are starting to move back into active, which I think makes a lot of sense, particularly in fixed income and alternatives. And one of the reasons is we're seeing these kind of embedded endogenous risks of market cap weighted indices and passive flows.
Yeah, some super important points. I appreciate your feedback there, and it leads me into kind of my third question for you, which is what's your overall investment philosophy or approach when you're managing funds or your own money or whatever, however you care to answer it. But are you a quant guy, fundamentalist, trend follower? What's your, what is the world through which you, what are the lens through which you view the investment world?
So we're definitely quantitative and we're definitely rules based. Now that said, we're not anti-fundamental. We're all at heart, we're researchers and we're big data guys. So we want to see everything and make the best decision that we can. Financial markets is inherently a noisy data set. I've been fortunate to be a quant in different industries, and I've spent years at American Express in their quant department underwriting credit cards. And there you have the benefit of very clean data. There's not this noise. If somebody's credit rating is a 750, it's a 750. If somebody's income is 100 grand a year, it's 100. You don't have noise around that. Well, you look at the price of IBM on any given day. There's an inherent value of IBM, but then the price is bouncing around, and so there's a lot of noise there. And so that's an inherently more complex problem. And so we are big believers in quantitative methods, rules-based methods. One of the things that's been fascinating to me, and there's another great book, which is phenomenal. It's from the 90s. It's called Beyond Fear and Greed. And I believe it was Andrew Sheffin, I want to say Harvard Business School, but Beyond Fear and Greed is a phenomenal book. And it came out in the 90s, before Kahneman won the Nobel Prize for all his work on behavioral economics, which kind of opened up the door where, anybody who has a degree in economics or has even taken economics knows there's so many assumptions around rational market participant behavior. And the one thing we know about market participants is, behavior is not rational. And so therefore opens up a lot of opportunity. But we want to put rules in place. If you look at, the one thing that will never be is, and it's not to disparage it or say that we don't believe in it, it's just not for us, is, kind of discretionary global macro, where you're trying to pick the tops, you're trying to pick the bottoms. There's, guys and girls that are great at doing that. That's not our approach. We want to have rules in place. We want to have a ton of data. We want to test a ton of things. Before, we launch a model, we'll test every different iteration to understand what that landscape of outcomes looks like historically, so we can have an idea of what the potential fragility is going forward. In an environment like this where computing power is very cheap, data is very cheap. I think and there's a lot of alternative data sources. We wrote a paper a couple of years ago that was a collaboration with the Johns Hopkins Department of Cognitive Science, where we scraped social data. Built our own natural language processing models that could then classify this. This was pre-ChatGPT, that could then classify it, according to sentiment and try and extract a signal there. That was related to the crypto market, which is kind of interesting in its own way. But my point is, that exercise, for a relatively small, firm, it took, we had some expertise, and it certainly cost time and money. But 10 years ago, that would have been very difficult. 15 years ago, that would have been impossible. The one statistic I like to tell people is when I was working at American Express, the software that we had on our computers back then was, it was 6 figures a year. Now it's free online, and every bit as good. So again, to answer your question, I personally, and the firm is very focused on quantitative, rules based, and also kind of being dispassionate. We don't want to, we want to change our minds. We want to be able to, open to new information. And just kind of seeking the truth at all costs.
Yeah, I am someone that thinks rules based is important, but there's people that disagree with that and have a different view, and they like calling the economic tops and bottoms and looking at stuff through that macro lens, which is some of the discussion that I wanted to have today. Not to have you call the top or the bottom, but I did want to get your opinion on what you're seeing from a macro viewpoint today in the markets, in the economy. What are you seeing as things continue to shift around? We're coming into a nice year in the presidential cycle, but there's also a lot of both tailwinds and headwinds in front of us. What are you seeing?
Yeah, so I actually threw some slides together, and this isn't meant to be comprehensive. I think it's the big things that we're keeping an eye on. So I think the biggest one, which is kind of the market expectations for the path of rates. So the first thing is the economy is still strong. I think that if we go back a year ago, today, a year ago this month, a lot of people were expecting the recession to be right around the corner. And, GDP surprise, the consumer has been very resilient. Labor market conditions, I think, are firmer than people expected. You can drill into that. You've got a lot of people that are holding two jobs and unemployment starting to tick up a little bit, but it's, the economy is strong enough such that the Fed is saying, it came out this week and said, listen, rates are going to stay higher for longer. And if you looked at, the kind of, what the market was discounting, on the second chart here, at the end of the year, the market was saying there's a, virtually 100% chance, 90% chance of a rate cut, in March. And now all of a sudden that's dropped to half. And I think that's going to go even lower. And so, and we've started seeing a repricing of risk assets. This week is a perfect example. The high beta assets are starting to kind of reprice to this reality. Now, the question, of course, is the Fed says a lot of things. Again, here's on kind of consumer resiliency. The Fed says a lot of things, but that doesn't necessarily mean they stick to that. The Fed also said inflation was transitory. So the next thing to keep an eye on, and this is something that we've spent a lot of time researching and modeling, is kind of QE versus QT. The one thing going back to 2008, I think the one thing that was kind of surprised a lot of people was the degree to which quantitative easing kicked into gear. And then fast forward post COVID, and we saw it on a scale that had never been witnessed before. Paul Tudor Jones, in his May letter that year, had a famous quote where he said 40% of all U.S. dollars, were printed, in the last few months. And so that shocked a lot of people, ourselves included. And there's going to be repercussions there. It doesn't necessarily happen immediately. And I think a lot of people were discounting that in 2023, but it's, that bill's going to come due. So, one thing is, the Fed's come and said, well, we're going to start tapering, we're going to start quantitative tapering, which doesn't necessarily mean they're going to be selling bonds on their balance sheet, but they can let them run off. They don't have to reinvest the proceeds. But to counteract that, they've got this repo facility, which you can kind of, it can get a little bit technical, but, repo is basically interbank lending. It is extremely important. It is the plumbing of the financial system. And if you go back, to the end of 2019, you started to see, and you can see it a little bit here. You started to see a spike in so this is dollars. If you look at repo rates, actually, you started to see some volatility in that market at the very end of 2019, and we were looking at that, and that was basically portending a credit crunch, which is why a lot of people, ourselves included, in a lot of our models, started getting bearish or defensive even before COVID hit. And then, of course, once COVID hit, everything went out the window, and quantitative easing came back, and quantitative, fiscal and monetary stimulus came back in a phenomenal fashion. But I mention all this because as deficit spending continues, we've got a massive amount of treasuries that have to be reissued. This repo facility, which is kind of tempered quantitative tapering, it's kind of been like a shadow QE. It's coming off. And so I think this is something that could potentially force the Fed's hand. It's about 600 billion left, down from 2.4 trillion. That has the potential to really disrupt not just the credit markets, but the economy at large. Without some kind of Fed intervention here, banks would tighten lending standards. If you look at Chapter 11 filings, we're starting to see a divergence from GDP versus filings here. This is a very interesting chart. So Chapter 11 filings in blue here versus GDP in green, and below that zero line is where we're getting more bankruptcies. And this is a kind of interesting historical correlation going back over 20 years, and we're seeing a departure here. Now that could kind of you've seen some deltas before. By the way, that blip that you're seeing back in 2004, I actually happened to be at American Express at that time. That was a change to the bankruptcy law, which encouraged a lot of last-minute bankruptcies that year, and so that's why you saw that spike. But we're seeing a real divergence now, and if you look at, back to my point about high yield bonds, there's a lot of those bonds that have to be rolled. And this is an interesting chart too, because these are that red box there is that's where interest rates have to get to. That's where Fed has to cut rates, for these debts to be refinanced cheaper. And so this is something we're keeping an eye on is the credit markets this year. I think the outlook for equities, you can kind of look at earnings and it's like, yes, valuations are rich, but you've still got kind of a robust economy. Election years are always a little bit, kind of interesting. I'd be surprised if equity markets were as strong as they were in 2023. But I'm also, I also don't necessarily think that we're going to get a big bear year. I think where the tail risk lies is in the credit markets, particularly because there's kind of this face off with the Fed right now, where the Fed is saying higher for longer. And let's not forget, the Fed is really spooked about the resurgence of inflation. Inflation is looking like it's going to be sticky. If you go back to the 70s, inflation double dipped. And inflation is a really nasty genie to put back in the bottle, and the Fed knows it. So they're gonna err on the side of probably keeping rates higher for longer until something really breaks. But we've also got the car on the other side of the highway, honing down on them, which is, the repo markets, the repo market is coming in. We've got Chapter 11 filings are soaring for both consumers and businesses, by the way. A ton of junk debt that has to be reissued, a ton of treasuries that have to be reissued. Fixed income markets are looking dicey. And so, that's one where, when we're talking to people, we're saying, listen, it's, 2022 could repeat itself in the fixed income landscape. At a minimum, you want to start being probably more nimble than you have been in the fixed income space. And it's also, last thing I'll say, it's last year it was easy to kind of sit in short duration treasuries because they were yielding, 5%, which, on a real basis is basically zero. But, that year, no one's getting fired for, parking in 5%. Well, that's, now there's an opportunity cost to that. And, when rates come down, which, frankly, I don't think it'll be in March necessarily, but I also don't think it'll be past the summer. I think the Fed's going to have to pivot in the summertime. And, to the extent that, what that looks like, we don't know yet, and what the, potential, quantitative easing looks like. But that's the thing to look at. But I think where we as, fiduciaries and investors need to be aware of is it might take a credit event for that to happen. And so that's where I think that's where the big kind of potential tail risk is in a lot of portfolios, is not on the equity side so much, but in the fixed income side.
I think it's interesting the idea that it has to come down, hundreds of basis points to have a stimulative effect or to have an effect. And I have a lot of friends in the real estate industry, we'll just say, and they're always marching to the drum of like the Fed's going to cut rates, and some mortgage rates are going to come down. And one of the things I've been looking at and asking questions about is the correlation between 30-year yields on mortgages compared to the 10-year Treasury, right? So we know that there's some kind of positive correlation there, and the 10-year Treasury trading at like 4, let's call it 4.5, even 4. And so the Fed comes out and cuts from 5.5 to 4. If that's where it's landing the rate, why would the 10 stay at the same price? Why would somebody take the duration risk? So it's almost, the question I'm asking is, asking myself in this scenario is, if the Fed cuts the rates, does that really bring down rates for the economy where people are refinancing debt, or does it help maybe roll some of that short-term stuff, but that almost signals the market to potentially reprice the 10-year and have the yield on the 10-year rise, which then pushes rates up for mortgages? And if that happens, then you have additional issues in credit markets on the longer end of the curve. So I'm not sure what's going to happen. I'm just trying to find the risks that are out there, and I'm curious if you've had any thought about, what the long end does if and when the Fed does cut rates.
Yeah, no, I'm with you. I think the likelihood of like the 10s, for example, I mean, there's I think the bias is for there to be upward pressure on rates, on yields for the 10-year, just for that exact reason. Like markets are efficient over time. They're going to reprice for that risk. And that's, real estate's an interesting, kind of sector too, because it's a huge part of the GDP. It's a huge part of our economy. And, like sales have ground to a halt in pretty much all markets, and there's, kind of the big, I mean, I'm here in Florida, I'm seeing it real time where it's just like there's, the prices haven't come down to reflect the new reality of, people's mortgage payment. And it's, it's just kind of stopped in its tracks, and let's forget about, that isn't, commercial real estate is its own beast. You look at the Blackstone, REIT, which is, kind of suspended redemptions or gated redemptions for its first time ever in its history. It's like that's the biggest, most liquid real estate investor on the planet. So the fact that they're having to, limit withdrawals or redemptions, from one of their funds, speaks volumes. So yeah, no, the potential for a credit event is very real. I think it opens up a big opportunity for investors. I think a lot of people, earlier this year, even last year, we had a lot of people were kind of very cavalier about kind of picking the top and saying now's the time to load up on, duration in the fixed income landscape. And one of the reasons I like, kind of momentum as a tool in the toolkit is it's inherently dispassionate. You can't convince yourself. The market is with, at the end of the day, market participants are voting, and the market, the price, is the most efficient, mechanism. And I'm paraphrasing Benjamin Graham at this point, but it's the most efficient, mechanism for kind of pairing off, what, all the information in the marketplace. And, we had one of our fixed income models was actually going short 20-year treasuries, and, tons of people are out there saying, no, now's the time to, back up the truck. And sure enough, you saw, a rip in rates. And again, it was because, a lot of people were kind of looking at, individual data points, constructing this narrative to support their trade view. And in the background, there were other things happening, like the repo market that a lot of people aren't following. And so it's like, you don't even necessarily have to have perfect information if you can, be mindful about, trend following or momentum in a rules-based fashion. That can do a lot of heavy lifting for you, particularly in uncertain environments where, for lack of a better term, we're dealing with the fog of war, imperfect information, and in particular, I mean, the Fed, the Fed has been a very active participant since 2008. And that's something that we really haven't seen before, quantitative easing and tapering and repo and like these were not tools that really exist, that the Fed had at their disposal pre-2008. And, now let's, fiscal stimulus, we haven't talked about like, infrastructure bill, green energy. I mean, for better or for worse, the government is printing dollars to funnel into the economy. And so there's some, the equity guys are jumping onto that. There's some interesting, trends there, infrastructure ETFs and things like that, for example. But yeah, I mean, just to bring it back to exactly what you said, I mean, I think the market to risk, the market to watch is the credit markets this year. For sure.
Yeah, that's but isn't it? It's kind of always that way in a sense, right? Like the credit markets lead the equity markets in a sense, right? The equity markets don't do much without the credit markets having, they have some kind of impact or driver, always. So, what else are you seeing? Anything else that you think is super noteworthy besides a potential credit event this year? Or anything, it sounds a little bearish, maybe, or it sounds like maybe you have some. You're looking at things that are setting things up for unfavorable conditions, maybe I'll say, but also potentially maybe just good opportunity.
I mean, if we go
volatility, right?
Exactly. I mean, if you go back to 2008, I mean, it was you said like junk bonds sold off hard as an example. But it was a generational buying opportunity after that. I mean, I remember buying J&K when it was yielding 20%, over 20%. So I'm not necessarily calling for that this year, but again, it's like, there will be opportunities for the patient investor. I also think, moving away from fixed income for a little bit, commodities are starting to look really interesting. commodities have been kind of out of favor for a lot of years for obvious reasons. With quantitative easing, volatility has been suppressed. Commodities have been less interesting. We're now moving into a kind of a new era again, post 2022. I think 2022 is kind of like the pre and post. Post 2022, we're seeing a normalization of interest rates, and I think with we saw massive fiscal and monetary stimulus, and I think with that hard assets, commodities start to look interesting again. So I do think we're at probably the beginning of a commodity super cycle. Again, if I were a betting man, I would say we start to see that this year at some point, maybe in the back half. And I think part of that is twofold. I think part of that is well, first of all, you've got elevated geopolitical risks, and I think that's here to stay. So you've got kind of the bigger macro. You've got onshoring, you've got a return to kind of a Cold War era where wars are going to be the norm. Geopolitical tensions are going to be the norm. The friendly global, everybody help each other that we had in like the 90s and early 2000s is gone. So there's obviously going to be a bid or a kind of a preference for things like oil, gold. But I also think too, just as from an investment side, a lot of advisors, a lot of investors are starting to look at commodities now for the first time in 10, 15 years. And so I think it's, I think you're going to start to see a lot of Wall Street dollars, flow into that asset class. And if you go back to like the 60s and 70s, a lot of people, a lot of my parents, they owned commodities. They had a broker, they had whatever silver bars at home, and equities kind of stole the show. Particularly after inflation subdued. But again, now we're getting back to an environment where commodities, I think, look more interesting. And that'll certainly be the case if we get a double top in inflation. If inflation comes back, I think for sure commodities start to look interesting again. And of course, we saw that in 2020, 2021. So commodities is interesting. Fixed income volatility. So commodities as an asset class, we think has a potential to be, multi-year bullish. Fixed income volatility, or I'll call it tactical fixed income, I think is going to be kind of a multi-year trade. On the equity side, it is, the U.S. was very quick to raise interest rates. The rest of the world is catching up. I do, so we've seen some dollar strength off of that. I think as that kind of wanes, the U.S. is going to start decreasing rates inevitably at some point. I think other countries might be slower to do so. That has interesting implications for, like EM bonds, non-U.S. dollar denominated bonds, for example. Just one example, we have a tactical emerging market bond model that we run, which is you can go to cash or can allocate to an optimized portfolio, a risk optimized portfolio of non-U.S. bond ETFs, and it's been sitting in cash for quarters, and all of a sudden this month it went 100% long. So it's again, I think that's starting to reflect that, all right, this is an asset class that hasn't been out of favor as long as commodities, but has not been interesting for the last year or so. I think that could be an interesting, kind of asset class for investors to look at. And then on the equity side, I do think, it's interesting. We're seeing kind of broad tech, and you and I were discussing this, kind of broad technology has kind of interestingly emerged as a quality play right now. If you kind of look at, even the last couple of weeks, the QQQs, versus like, value, or, staples or low vol or dividends, the high beta stuff has sold off with this kind of repricing, innovation related ETFs. But the kind of the broader technology has held its ground. So it'll be interesting to see kind of how that evolves this year. I do think this is probably going to be a year where the quality factor in general gets a little bit more strength on the equity side. I would caution against low vol as a factor. That's a very interesting one. If you look at 2020, from a quantitative perspective, that's one where index construction matters a lot. That's a whole separate 60-minute TED Talk that I'm happy to, to talk to anybody about. Low vol is interesting, but it's one I would caution against. I think quality is kind of the broader catch-all that I think could be interesting this year. But just in general, I think tactical, as a strategy is coming back. I think investors are starting to, or active, let's call it active. I think investors are starting to recognize that active can add a lot of value kind of across asset classes. And now, the world has changed post 2022. Now is when investors probably want that in their toolkit.
Yeah. Well, obviously, as a host on the NAAIM Confidential Podcast, I believe very heavily in active management. Always have. I think it's more informed decisions, and it's an opportunity to manage the risk return profile better than just passive investments, in my own opinion. So that being said, Ben, I appreciate you taking your time to give us some insight today. Certainly a wealth of knowledge that you've shared with us. If somebody does want your 60-minute low vol TED Talk, Ben, how does somebody find you, reach you, find your firm, get a hold of you, whatever?
Yep, they can just idxshares.com is probably the easiest way, and then we've got a contact on there. And we look at everything, and I'll tell people, we always say we're a research shop first and foremost. So we have people say, hey, can you opine on these two ETFs? What do you like? What do you dislike? We're happy to help in any way, shape, or form. Even unrelated to our product. So it's I encourage people to reach out.
Cool. Awesome. Well, we certainly appreciate you being such a great name to friend to name.
Absolutely. Thanks again. This is great.